Then I wanted to talk a little bit about stock sleeper builds. And I would also love to know what your sleeper builds are over in the chat. So if there are any companies that have been performing really well quietly that people aren't really talking about, I would love to know what you're sort of looking at, what your thoughts are in the chat. And I know that we have like our Mag 6. It was formerly the Mag 7. Tesla's kind of out of that now. We have our Mag 6, and many of these have been like a very consistent topic of conversation, in financial media, across traders. But we have Microsoft, Apple, Nvidia, Amazon, Meta, and Google, which make up pretty big components of the S&P 500. These are something like the top 10 holdings of the S&P. They make up a really big chunk of our market. And we've seen some really significant growth across some of these, specifically Nvidia up 226%, Meta up 141%. We have Microsoft and Google, which are up around 40 to 50% each. And then Apple, which is kind of lagging behind a little bit. But all of these, a lot of them have been propping up this market where the S&P has been trading at around 28% on the year. That's about how much it's grown in the past year. And then you also have the ones that people are just kind of talking about because their moves have been nuts. So you have obviously SMCI, which recently news broke that it's getting added to the S&P 500. It's up almost 700% on the year. So looking at the last 252 trading days, it's up quite a bit. Nvidia obviously up 226%. Eli Lilly up 130%, and then AMD lagging behind, but still up 80%, 86%. So it's up. All these are up a lot on the year, and they have been highly discussed. But what I wanted to know was what underlines in the S&P 500 are actually up a lot that just aren't very popular in terms of like how people in financial media talk about them. So what I wanted to look at was I wanted to find some stocks that were currently in the S&P 500. I wanted to look at share prices that were over $50. And I wanted to identify less discussed names that have grown over 100% in the past year or 252 trading days. And I wanted to evaluate the risk to reward of all of those like kind of sleeper builds using the Sharpe ratio. Make sense?
Makes sense.
Yes. Okay, so the Sharpe ratio, for people who are not familiar, who have maybe heard the term before and just don't know exactly what it is, but the Sharpe ratio is really one of the most popular ways to look at the risk-adjusted returns of a stock or portfolio. This doesn't work very well for looking at option strategies, and I can make a whole other piece about why that is. But what we're effectively trying to use this to measure is the excess returns relative to some benchmark of a specific stock. Or portfolio or anything like that. Basically want to know like how much excess returns something is making relative to some benchmark. And a lot of people typically use the risk-free rate to measure that benchmark. So you calculate it by looking at the annual expected return of an asset historically. So you basically look at the annual performance over the last year, and you kind of use that to estimate the expected performance over the following year, and you subtract the risk-free rate from that. And typically what you would use is the interest rate on a 10-year treasury note. Here I used about 4% annually for these calculations. And then you divide those by, so that's like your excess return. And then you divide those by the annualized historical standard deviation of returns, kind of estimating our expected volatility from the following year using that. Does that make sense?
Yep.
So we have AIG, which we have talked about before on the show. But this one is up 174% in the past year, and it's actually the third best performing stock in the S&P 500 after SMCI and Nvidia. So this one has had quite the magnificent rally, and it's actually one of the top performers in the entire index that I feel like a lot of people don't normally talk about. This one's been pretty interesting to watch, to be honest.
Third. Yep.
So this one's up 174%. We also have BLDR, which is up 133%. This is the building materials company. This is the fifth best performing stock in the S&P 500. We can again see like how strong that performance has been over the past year. So we had, this is an insurance company, and then we have a buildings materials company, and then we have Uber. So kind of all over the place in terms of our sectors, actually. But Uber was actually the seventh best performing stock in the S&P 500. It's up 128% in the past year. It's down, down a little bit this week. But again, the sectors in terms of these really strong performers, kind of all over the place. And Uber actually ranked seventh best performing stock, which has been pretty interesting. We also have CEG, which is an energy company. Again, totally different sector, totally different type of company compared to some of the other ones that we were looking at. That was the 10th best performing stock in the S&P 500. We also have DEC, which is a footwear designer, and it was in fact the 9th best performing stock in the S&P 500. It's up 106% in the past year. So people are really liking their footwear, I guess.
That's super weird. Deckers, never heard about the company. I've never heard about Deckers before.
No one has, but it's up 100%. It's up a lot. No one talks about this.
No one talks about it. Just 136,000 shares volume today.
Yeah, it's not. The liquidity is not there, but the growth is certainly there. So really strong grower up in here for a footwear designer. We got Deck. We also have, are you ready for this? In terms of like just getting all over the map in terms of exposure, we have Royal Caribbean, which is up 102% in the past year. Quite, I don't know, risen from the ashes a little bit after the pandemic. Again, one of the strongest performing companies in the S&P 500. And then the one that I'm most annoyed about, we have Netflix up 100% in the past year. So this is another very strong performing stock. This has been a little bit more a topic of conversation. I know that people are talking about its gains, but not really talking about its gains relative to the rest of some of these companies, because this has even outperformed some of our Mag 6, right? Bad Trader Cruise, huge fan of that.
Why are you mad annoyed with Netflix?
Because their stupid password sharing crackdown. Now everybody's going to be doing it because their stock price is completely popping off. And again, according to these criteria, looking at S&P 500, over $50, over 100%, these were the ones that seemed the most interesting to me. But I had to throw in one more because it didn't grow over 100%, but General Electric, low key, up 85% in the past year. 85%. Nobody talks about this. Everyone brushes over General Electric. It's actually having a really strong year, which is kind of interesting.
For it being the company it is, and a big company, and nobody talking about it, I don't know how I actually came up to that. Oh no, I remember. I was watching the most overbought stocks with an RSI on Friday, and GE got my attention.
This is now it's got my attention because I'm like, I haven't been watching this. This is like kind of like a boring stock. No one talks about like, oh, it's an electric company. It's General Electric, but it's actually been doing really, really well. And when we look at the Sharpe ratios, so these are again our risk adjusted rewards. If we compare our kind of Mag 6 to some of these other tickers that we looked at, so we have SPY, Microsoft, Apple, Amazon, Nvidia, and then some other tech names. And then we compare the Sharpe ratios. So this is, again, the amount of historical excess returns that these stocks have experienced divided by their historical risk to get kind of an expectation of what the risk to reward ratio is going to be moving forward. We can see that these tickers actually pretty consistently do well compared to even the Mag 6. A lot of them are even higher than the market. The S&P 500 is rocking an annualized Sharpe ratio of 1.87. And then a lot of these are over 2 actually, which means they have better risk-adjusted rewards compared to even the market. And the only ones that tend to do a little bit better are the ones that had really strong performance this year from the Mag 6. So we had Nvidia of a Sharpe ratio of 2.66 and then Meta of 2.48. And we can see even here, AIG lagged behind a little bit, but a lot of these other companies have Sharpe ratios that are well over 2, including General Electric at 2.75, which is the biggest one on the entire map.
So now I think that I actually maybe did wrong on going short on General Electric.
I mean, not necessarily. I mean, you could argue a reversal. There's 100 reasons why you could trade, you pick your directional assumptions. But historically, it's actually had really strong risk-adjusted returns. It's had really stable growth, much higher than the risk-free rate, with not a lot of volatility. And when we compare something like this to something like, let's say, CEG or Netflix, if we look at this volatility profile versus this volatility profile, how consistent it is, kind of shows that risk-adjusted reward numeric in a little bit of context. And if we look at the top Sharpe ratios of the S&P 500, we actually have Eli Lilly is right at the top, and then right below that is General Electric. It is even better than Nvidia from a risk-adjusted reward perspective, even though it's only up 85% on the year.
Quite interesting that.
So I think it's pretty interesting. Nvidia rocking 2.6%. And then we have a couple of other names that I don't really trade. You got SMCI at 2.59%. And then CEG, which was one of the other ones that we looked at, that energy company, MLM. We have a couple other names that are doing pretty well. But again, I guess the point of the segment was to just kind of compare this to our Mag 6. And the Mag 6, while you do have Meta and you do have Nvidia that did have pretty strong performance last year, even though there was a lot of volatility, they had pretty strong risk-adjusted returns. But compared to some of these other names that are just quieter, actually underperformed if you look at it relative to this.